Here's what they don't tell you. Business vehicle loans always have sky-high interest rates. False. The real edge isn't in resigning yourself to those rates, it's in how top-performing companies sidestep them entirely. The playbook is radically different from what most business owners hear at the dealership. Stick around because the real secret has very little to do with the number on the rate sheet and everything to do with how you structure the deal. First, let's blow up the standard approach. Winning companies understand 3 secrets that most business owners miss. Secret 1: stop applying for loans in your business's name alone. The smartest founders leverage their personal credit profile to unlock dramatically lower rates. Why? Because personal credit scores almost always yield better terms than a new LLC with thin credit. According to national averages, a prime personal borrower can access rates as low as 4.75% for new vehicles, while a business-only application often faces rates north of 9%, sometimes more than double. Case in point, a Los Angeles logistics startup founder personally guaranteed his fleet's first 3 vehicles, securing a blended rate under 6%. That saved his business over $20,000 in interest over 5 years compared to standard commercial rates. Secret 2: use non-traditional lenders strategically. While banks pitch their business vehicle loans at headline rates, alternative lenders, including credit unions and online fintechs, quietly offer tailored deals. In 2025, credit unions have consistently published new vehicle rates below 5.8%, while traditional banks hover above 7%. One construction firm in Ohio shifted its entire vehicle financing to a local credit union, using an association membership hack. The result? The company cut its average APR by 2.5 points, slashing annual interest expenses by nearly $9,000 across its fleet. Secret 3: play the manufacturer incentive game like a pro. Most business owners see those 0% APR for 36 months ads and assume they're reserved for consumers with perfect credit. But top-performing companies work directly with fleet sales reps at automakers who can unlock fleet-specific programs with subsidized rates or cash buydowns. For example, in 2024, a Texas HVAC company negotiated a Ford commercial fleet deal, accessing a 1.9% APR for 36 months, less than a third of the published business rate. The trick? They bundled orders and provided proof of business insurance, qualifying for a hidden tier of fleet incentives that most dealerships never mention. Here's how this all comes together. Imagine you're standing at a fork in the road. Down one path, you do what everyone else does. Walk into a bank, accept the posted business vehicle loan rate, and walk out with paperwork that locks your company into high interest for years. Down the other, you realize the game is rigged for those who ask the right questions, use the right credit, and know where to look for real leverage. It's not just about the sticker APR. It's about knowing the shortcuts, the backdoors, and the unadvertised programs that only industry insiders tap. Think of it like this. Most business owners treat vehicle financing like buying a ticket at the airport counter, full price, no negotiation. But the savviest founders treat it like booking a secret fare online, using every available trick to unlock the best deals. They don't just accept the first rate, they optimize, stack, and negotiate until the numbers work in their favor. Here's the number that brings it all home. Companies that combine these 3 strategies, personal guarantee, alternative lenders, and manufacturer fleet incentives, can reduce their average vehicle loan interest by up to 50% compared to business-only, bank-issued loans. That's not theory, it's a documented outcome across high-performing fleets in 2025, where average rates for top-tier borrowers dipped below 5%, while the average business-only applicant still saw 10% or higher. The takeaway is urgent. Stop assuming business vehicle loans have to be expensive. The spread between what the average business pays and what the top 10% pay is now wider than at any point in the last decade. In 2025, the posted business vehicle loan rate is just the starting point. The real winners are those who refuse to play by the old rules, who demand custom terms, who know the right lenders, and who aren't afraid to mix personal credit with business leverage when the math makes sense. If you're running a business and your vehicle loan APR starts with anything higher than a 5, you're leaving money on the table, money that should be fueling growth, not lining a lender's pockets. The best-run companies treat vehicle finance like every other procurement challenge, with relentless optimization, data-driven negotiation, and zero loyalty to legacy banks. So don't just settle for what's on the rate sheet. Build relationships with credit unions. Tap into manufacturer fleet reps for hidden incentives. And when it's time to sign, stack the deck by combining your strongest personal and business credit assets. This is the playbook the pros use. The only question is, will your business join the ranks of the few who pay half as much or the many who pay double? The choice is yours if you know where to look and if you move before the next rate hike hits.